Now, retail audience, I know for a fact, don't like booking losses. Even though there is an opportunity, they say that if I sell it and buy it again, but you are not scared of booking the loss. You said, I'll book the loss, I'll find something better. Why is that? And why do you think retail doesn't do this?
They kind of stuck with that single transaction. But when I look at tax loss harvesting, I'm looking at things as a portfolio. You made a mistake, for example. You had stock number A and it's currently at a 50% loss for you.
It has to go up 100% for me to break even.
In the same moment, you might have seen a stock B. So wouldn't it be better, which probably can go up to 100, better visibility that this thing will go 100% rather than stock A, which has actually dropped down by 50%. So wouldn't it be wiser for you to redeem this, sell off this A and put your money in B where the conviction is higher? So the probability of success becomes a lot better without you losing anything in the process.
So, hi Shankar sir. First of all, as you know, every time I come to Delhi, I'll give you a call. I told you this last time. So, I'm back in Delhi and I thought we'll just do a very quick podcast. By the way, just for the audience, we have not scripted anything. We thought we'll just come sit and I'll just ask questions to you because obviously you're a very senior person in the space, right? So, you know a lot of things. The first question I want to ask you, sir, what are you doing in this fall?
Yeah, firstly, thank you for inviting me again, Shashank. I think last time we spoke, when was that? That was in
3 months ago, maybe?
3-4 months
Yeah,
back,
we spoke a lot of interesting things. A lot of beautiful companies that were there.
And a lot has changed in those 3-4 months, right?
Everything's down.
So I think I was a little laid back over the last 1.5 years in terms of investing more money into the stock market. But now I think, it's a period where you can see a lot of hidden gems, they're suddenly becoming visible. So things which I wanted to buy, which I couldn't buy for the last 1.5 years, I think it's a lot more visible now. So I have kind of started my hunting once again and, picking up more stocks at the moment. So that's what I'm into. So thankfully, I'd kept some money aside. So I'd not aggressively put money over these last 1 year plus. And now I'm kind of deploying all that cash.
So this, I want to ask you a question because this, I told you, right? I screwed up on this part. I didn't keep any cash. When the market was all time high, I said 2-year breakout finally, and I went all in 98%. And now the market has fallen and I don't have any dry powder to invest. Did you have a framework for this, or did you just by chance have it on the side? Or do you keep like a...
So thankfully what happened is this period also coincided with the financial year ending. So that's generally the time when I do my tax loss harvesting.
Okay.
So because, the valuations were down for a lot of stocks and there were some mistakes also we make over time. So this was a great time for me to actually knock off those mistakes. So even stock mistakes, even in mutual funds, certain mutual funds aren't been doing well because of, their own problems. So this was a time when I kind of got rid of those things. I replaced it with potentially higher performing, better structured stocks and mutual funds. And the cash which I had, I was able to deploy that also. Now, obviously, you need to, with time, wisdom comes in, right? So you've gone through that period where, your small caps and your micro caps, they went from being a 200 to 100 and then 150. There was a glimmer of hope. Then again, it's down to 100. So it's kind of improved the way, at least, in which I kind of structure my portfolio. And hopefully I've done a better job this time as compared to what was earlier.
So tell me one thing. You said you have done tax loss harvesting at the fall, right? I'm assuming there will be some companies that are in loss also because the market had fallen by then. Now, retail audience, I know for a fact, don't like booking losses. Even though there is an opportunity, they say that if I sell it and buy it again, etc., right? But you are not scared of booking the loss. You said, I'll book the loss, I'll find something better. Why is that? And why do you think retail doesn't do this?
Yeah, because, why retail doesn't do it is because they kind of stuck with that single transaction. But when I look at tax loss harvesting, I'm looking at things as a portfolio. That this is giving me an opportunity of reducing the mistakes which I have created and replacing it with, more potentially opportunistic avenues which are possible. So it's like saying, you made a mistake, for example. You had stock number A and it's currently at a 50% loss for you. My question to you is, would you want to continue with A? Okay. If the answer is yes, then obviously I'll ask, what gives you the confidence that this is going to come up once again? Because that's the only thing you're thinking.
It has to go up 100% for me to break even.
It has to go up quite a bit. But in the same moment, you might have seen a stock B So wouldn't it be better, which probably can go up to 100? I mean, you have a better visibility that this thing will go 100% rather than stock A, which has actually dropped down by 50%. So wouldn't it be wiser for you to redeem this, sell off this A and put your money in B where the conviction is higher?
True.
So that's the logic which I use. So my objective is to always improve my portfolio. I can't be stuck on a single transaction. And that's where a moment like a tax loss harvesting really helps in kind of measuring things. So I would have booked losses of, everything put together, booked losses of about 10 lakhs.
Yeah.
And there were some gains also from my mutual funds and some stocks also. So I was able to mix and match the two of them, and I was able to get my tax capital gain, tax slash losses to zero. So it's a complete net off that I was able to do. And my portfolio from what was earlier, it's definitely a lot better. And I'm more convinced with my portfolio.
So now you're ready for the next cycle.
Exactly.
Okay, understood.
So the probability of success becomes a lot better without you losing anything in the process.
Fair. So now I always say this, that when the market falls is when our work becomes double, because you're always running around to find companies or stocks on how do we invest now with good value. First of all, with this fall that has happened, do you believe that a lot of companies have come which is very good value, or only some companies have come and we're still slightly overvalued on some places?
So there'll always be certain sectors which are overvalued, right? So that is always the case. But I think overall, it's definitely a lot better as compared to what it was. So you can actually see it in 3-4 phases. The first phase was probably the peak phase, which was September 2024, December 2024, that phase which was there, where everything was expensive. Across the board. Then there was this February, March 2025 phase, that the tariff initial, this thing which was there, where things went down. Then again it went up. Yeah. So September, October of 2025, again it kind of went up. It did not go as high as a September 2024, but it definitely went up decently, right? And then it came down. Now, what you need to compare is Feb March of 2025 with Feb March of 2026. Okay. Now, this is where I'm seeing that generally this thing is kind of at the same level, or this one is slightly higher. But this is actually better than this, because at that time the uncertainty was higher because the tariff was directly affecting us. But this time that uncertainty is a bit lower because the war is not so directly, it's not our war, exactly. It's not affecting us so much as compared to what it was at that time. The second thing is the earnings bit also. So in Q2 and Q3 of 2025 was actually a very bad period in terms of earnings also, right? Most of the companies did not earn enough in terms of earnings growth. However, that's not the case now. The median earnings which have come in is a fairly decent number as compared to what was 1 year back. So it's a better period now as compared to what we saw in February and March of last year.
Beautiful. And when you sit down and say, okay, now the markets become cheap, let's find some good stocks, do you go sector first or directly you start finding stocks?
I generally avoid the sector. The sector comes second. First is to really go bottom up kind of a approach, saying which are the ones which have kind of lost pace. Now, there again, I've learned a few things now over time. So one thing I've learned is that try and go for companies which are the market leaders to the extent possible, right? Even if it's a small niche, it's okay. But go for the market leaders, because these are the ones where the recovery is generally the best, that comes in. And these guys are smart enough because they have been in this sector for 20 years, 30 years, 15 years. So they know when is the right time to actually put in more capacities and grow their business. So I kind of go for people which have a minimum market share of at least 40%.
Wow. Okay.
So now those guys are extremely cheap. They're really visible at the moment.
So niche companies in a niche market share, but they have dominant market share. Niche market share become big?
Yes, it should become. The visibility should be there for the next 5 years at least. Like I was just talking about Indigo Airlines, for example, right? So that's dropped by 30-35% from their peak levels. And obviously, it's a temporary phase that's going on, with this war that's happening in the Middle East. That's what is contributing to this massive drop there. But the big question to all of us is, it's at a market share of 60%. In the next 5 years, who do you think is going to decimate these guys? I can't think of anyone.
Only Air India is there, but at 25% mark.
25%, they will go up to probably a 35. These guys will, let's say, go down to maybe a 50, assuming Air India does extremely well and Indigo does extremely bad, right? It's just tough, right? So if that's the scenario I'm looking at for the next 5 years, then it's better to go with the leader.
Yeah.
So the underdog play, I've kind of reduced it massively now, saying that, I don't want to chase the underdog. I want to be with the leader, because that guy will actually be the one who's the person who will create the path, and others will simply try and follow him over time.
So what are some niche companies you've seen in the mid-cap space, or the ones that have become cheaper? Niche market share guys that have become cheaper maybe in the lower end as well?
So tons of them actually. So for example, you have companies in the recycling space which have become definitely cheaper. So people like Gravita, for example, they were at 40, 45 P. It's now available at 25. So it's kind of halved in terms of P. It's not halved in terms of price, because their EPS has been growing up and it's consistently up from where it was. In fact, there's a very interesting thing with Gravita. They double their revenue every 4 years. So 2014 to 18, from 500 to 1,000 crores. 18 to 22, 1,000 to 2,000. 22 to 26, 2,000 to 4,000. And now their vision statement and the way they're kind of capacitizing their entire thing is to grow from 4,000 crores to 8,000 crores in the next 3-4 years. So it's a kind of tried and tested model that they have, that this is what we need to do to kind of doubles. That's there.
But can we go a little deep into it? Like, what does it do? What is the sector? Is it good or bad, or is it going through some phase? Just to understand.
Yeah. So see, recycling is multiple components there. Okay. So there is the societal angle, number one, which is no one will say recycling is bad.
Correct. Absolutely.
Okay. And we in India, we recycle in our own ways. So we have those jam jars which are then used to put in pickles inside it or to put spices there. And we all are inbuilt recyclers in our own ways. But even there are like today I'm not wearing it, but normally I wear a Neiman's shoe, which is made out of recycled material. There are t-shirts, which are now from recycled polymers, etc. So there's that entire societal angle which is there. Then there is the environmental angle which comes in. So there's something called EPR, which is Extended Producer Responsibility. What it basically says is that the person who creates the product, he's responsible for the sustainable recycling of that same product. So just to give you variations of that, for example, there is something called a plastic waste management rule in India, PWMR we call it. So what it says is that when a FMCG has a shampoo bottle, 30% of that plastic that's used in that shampoo product in that bottle has to be recycled plastic.
Wow. Okay.
So that's a rule. Okay, it's just being implemented. It's in phases. So first, I think it's 10%, then 20%, then 30%. So that's how everyone has to go up. Similar thing with lead, for example. So lead is another thing, which is environmentally harmful, right? In more than one way. Now in lead, the remarkable thing is the lead acid battery that we have, Exide, Amaron, etc. The lead that's there inside is completely recyclable.
Okay.
Lead doesn't decay. So if there's 100 grams of lead inside it, you can easily recycle 99 grams out of it. So today those batteries that we pay 4,000, 5,000 rupees for is actually made up of recycled material only, because, and that's where the economic angle also comes in, that it's more expensive to mine for lead as compared to recycling.
Correct. So we can reuse it very well.
So now what are the products where this is getting extended? So they started with lead, then there's rubber, there is plastic. How do you have rubber? The tires. So Tina rubber, for example, is recycling those tires, etc. Then you got plastics. Plastics is basically Ganesha Ecosphere. They are massive into plastic recycling, correct? You have lithium, which is now getting recycled. Gravita is getting into it and slowly. Gen recycling is into copper, aluminium and lead recycling.
They're the biggest in the market right
In
now.
copper, they are the biggest, definitely, by a fair distance. 50+% of the revenue is copper, and another 40 odd percent is lead. So again, different companies have different things. So JN Recycling is half copper, half lead. Gravita is 87-90% is lead. Same is the case with Pondy oxides also. Ganesha Ecosphere is more of plastics. And all these companies, what they realize is it's a horrible thing for us to simply recycle it and give it back. So what they do is they convert that into value-added products. So that's where the margin improvement happens. So if they do the simple stuff, they'll probably get a margin of 7%, 8%. But because they convert it into some value-added product. So for example, this Ganesha Ecosphere guy, he converts it into polyester, yarn, something like that.
Interesting.
So that the plastic, it gets threaded and it's now become like a fabric.
Wow.
So use the fabric. So this is how the recycling part actually goes in. So there's a entire value added process. So Gravita, for example, I think its value added percentage is like 45%. Yeah. So half of the stuff that they do, they actually are able to convert it into some value added product, and that's where they make 12% margins, if I'm not wrong.
So these are like long-term plays, right? Because recycling is not going to stop anytime soon.
So that's what the first thing I want to look at. Okay, I want to look at plays which I know are going to be there for the next 10 years. There's no disruptive thing there. You have to recycle. Like tires is a very interesting thing here. In Europe, what they do is every tire has, I read it somewhere, has some QR code or something so that the manufacturer can track where it is.
Okay.
They might not, it might not be absolutely precise. For 10 years, they will know in whose house that particular thing is. That might not be the case. But there is a way of tracking that Europe has currently done. And 90% of the tires that they have, that gets recycled there. In India also, the number would be decently high, but we don't have the exact numbers because there's a lot of unorganized recycling that happens in our country.
Yeah.
Then related to environment, there is also this angle of what big companies want to do. So big companies have this ESG goals, etc. with them, right? So they are very careful on who they give their stuff to. They don't want to be caught with giving it to some kabadi wala or some, unorganized scrap dealer. So they prefer to give it to people like Gravita, people like Ganesha, etc.
Organized
guys. Exactly. So they are very, they know what they are doing exactly, and that's what, again, the big players have comfort in. So as the country becomes more and more organized, this thing will become even more important, that it goes to people, who are in the formal sector of the recycling this thing. So that's the play which I'm kind of looking at, that most of these big players, they're likely to grow at 25% plus for at least the next 5, 6, maybe 10 years. Yeah. And it's something which has government support massively with all this EPRs and plastic waste management rules. There's also a battery waste management rule, which is specifically for batteries. And there are a lot of these things which
are coming up.
Lithium is kind of coming up right now, correct? So all these things are tailwinds which are there with complete support from the government on these things. So this is the kind of environment we want to pick stocks from, basically.
Any other sector you're seeing right now that has beaten down but very good, similar like recycling, like
also
long term?
On the electrification space, a lot of the companies have been beaten down. Okay, and when we look at electrification, it's a very massive space actually. The way I kind of look at it is there are certain execution companies, transrail lighting kind of companies who do EPCs exactly. And then you have the manufacturers. Right. So you have people like Darrell or Silchar, which are into transformers. You have Skipper, which creates those transmission towers, so those things are there. So between these things, I prefer the ones who create manufacturers rather than people who are the executors. Even those guys have dropped massively. So Silchar was 30-35 valuation. It went below 18.
Really?
Yeah. It's even now at about 21, 22, if I'm not wrong. Same with Skipper. It also is around 20, 21 at the moment. So all these guys have actually come down massively, and the revenues have still kept pace. That's the best part. And how you measure it with these companies is clearly on capacity, because these guys are always working on optimum capacity. And it's just a function. The demand is definitely there. It's just a function of whether they have the capacity or not. So if I take Skipper as an example, right? So these guys have been adding capacity from time to time. Okay, so they had 3 lakhs megawatts of some capacity, which they increased by 75,000. Now they have another one which is commissioned, so it's going to go up anytime. So another 75,000, and then they'll keep on increasing, because the demand is not slowing down. So if you do the revenue track also, you can actually look at the capacity to understand, how much the revenue is going to go up. So the revenue has not fallen. It's pretty good, but the valuations have fallen massively for these.
What are the negatives of this? Why do you think it's fallen? Is it just because of the market correction, or maybe some other narrative is also playing here?
I could not see any other narrative which was very dominant, because capex, electrification, these are all themes which should actually do better now. Correct. Especially with this budget announcement, etc., where some, if I'm not wrong, 12 lakh crores has been pushed towards infrastructure, etc. So the public capex is definitely there. So it should not have come down. So it's sometimes very difficult to pinpoint, why things go down or go up, both ways.
But no narrative based.
No narrative based has come in as to why this would have happened in this way. With certain things I can still understand. So another area is banks, for example.
Private or public?
Mostly private. Mostly private. And there the narrative, I can understand that the FII money is all there. It
was not in PSUs.
it's not in PSU, right? It's all in private banks, right? Your Kotak, your HDFC, your ICICI, etc. So if FIIs are pulling out money, then one of the first sectors to be affected is your financials, and which is effectively banks, private banks, right? So that storyline was very visible. But on electrification, it's not really that visible.
So these are all I like the way you think. So you're basically talking about micro segments, micro niches that can become bigger themes in the future. Because when you look at the broad market, everyone's like construction, cement, bank, things like that. Nobody talks about recycling. Recycling not even become a proper sector yet in our...
No, it's now trending, I think.
I'm saying
I see
from
a lot
all
on
these...
Twitter nowadays.
Twitter, everything is trending.
Exactly.
Unlike these institutions, right? When they make these sector reports, they have auto, banks, financials.
Okay. Yeah, there's nothing called recycling.
Recycling nahi aaya. So only once that starts getting formalized is when the formal money starts coming into these sectors and they start playing out. Very interesting.
One area which hasn't dropped enough is actually things like auto ancillaries, for example.
Why do you think so?
So that's... I don't have an answer again for why.
I know most of them are still close to their highs.
It's a decently there, It's maybe a little bit they must have dropped, but not much actually. So again, one of the narratives can be that your commercial vehicles and your passenger vehicles, it's done well in the last 1 year or so, right? So maybe the orders are enough with the auto ancillaries to sustain themselves for the next couple of years.
Well, I think Vahan data also is coming out quite well. I think the recent two-wheeler data I was looking at, I think Ather had jumped 80% year on year, and I'm like, kaun kharid raha hai bhai itna? Matlab, so there is a migration happening from ICE, and now because of the...
Ather is the only reason I have Hero Honda for so long, because they have those shares with them, right? So that's helpful.
So I think the whole migration of combustion vehicles to electric vehicles is where this play is happening. And auto answer have actually positioned themselves very smart. They've automatically now start going more into EV. They've realized that this is the future and things like that.
Even in the auto ancillary space, I see, so there are those specific things. Last time I think we spoke about SGS, for example.
Yeah, wonderful company. Wonderful company.
Even certain companies are there which are... So it's all about how much of money is there on the value add that is there. That's where the certain auto ancillary companies are going. So for example, that because you mentioned the Ather, etc., the dashboard that's there. It's a LED dashboard which is there. It's got certain functionalities, etc. It's a combination of software, hardware, all put together. Similarly, there are certain kind of mirrors now which are coming in.
Yeah.
Not just that.
The light in the mirror.
Yeah, there's something there,
Don't overtake kind of blind spot indicator.
So there are things like that which is there. Of course, there are those Other functionalities we know, where the brake automatically gets applied, when there's a collision, this thing that's there. So that's where a lot of the new kind of innovation is happening on the ancillary side. And this creates obviously more opportunities for these ancillaries to make more money.
I have a very weird theory. I was talking to someone recently about auto companies, not the auto ants, like your Hero, TVS, Bajaj. Because I was looking at the data, I was mind blown. And obviously, it's a migration shift. I had studied the old migration where we went from geared scooters to cycles to geared scooters, two-wheelers. Then we went to bikes. Then we came back to the Honda Activa era, which was non-geared scooters. And now we are going back into this category, which is the migration. So this migration usually happens over 7 to 8 years. It's a long migration, but the winners of that migration make a killing because it's replacement theory. I believe that in the next few years, our auto companies will also become SaaS companies because very soon, it's not happened yet, but I wouldn't be surprised if you charge me a subscription for XYZ. Tesla tried it with FSD at that point. Now they made it free. But I know I have a Mahindra car and they tell me you want to use the app, Mahindra app, you pay me 1,500 rupees a year. I don't use it today. But I don't see a future where there will be something that they give me and I will pay 500 bucks a year. Right? Multiplied with the number of car owners, you get sustained free cash revenue, which is zero OPEX to spend. So that I feel will happen because I know Ather has these great products and TVS, Bajaj. How difficult it is to put a subscription on it?
It's the same concept that we saw with the one who kind of really did it well is Amazon, because Amazon is what? Amazon is an e-commerce company. So one way of thinking of that is I get the product from the seller, I give it to the consumer, I'm just the person in the middle. But then they converted that entire model into a subscription model by bringing in Amazon Prime. And how does it affect people like you and me is that we don't go anywhere else.
Yeah.
Once you have that Amazon Prime subscription, by default, your e-commerce platform of choice becomes Amazon.in.
Yeah.
And you trust that, it's probably going to be the lowest price there because, I'm a paying Amazon Prime customer, which is not the case actually. You can actually find better deals on Flipkart also sometimes. But you get used and you get suckered into that ecosystem that they've created. And then they complement that with videos and music and all that stuff. So it's a science then, how to keep you within that subscription system, which I think Amazon has absolutely perfect.
It's actually very, very interesting. When you spoke about it, their job was to take mal from one point A and give it to point B. Now, if they do it faster, it's good for them and it's good for the consumer. They just said, I'll give it to you faster, you pay me money. It's like Zepto saying, Kal main aapko 10 minute mein delivery dunga, give me 500 rupees subscription or else you'll get it in 25 minutes. I would actually take that 500 rupees subscription.
So I read a couple of years back, some article was there which said that irrespective of whether you are an Amazon Prime customer or not an Amazon Prime customer, it goes through the same logistical pipe, so it really doesn't matter. You're going to get it probably on the same day.
Yeah, because there's a loss to Amazon if it's slower, right?
But a lot of things how can you slow down a process?
You can't.
You can't, right? So you have to keep it in this thing. There's a very nice book called Goal. Yeah. It's by Eliyahu Goldratt. Very old book. Yeah. It talks about the same thing. So what is happening is a bunch of kids were there and they had to climb a hill. Now, obviously, one kid was super enthusiastic, fast, thin guy. He would go faster in the line. The fat one would be, lagging behind. Now, the goal for the professor was how can I get everyone together? Otherwise, it's like the production line where imagine something is happening faster, something is happening slower. The whole production goes for a toss, right? So what he did is he got the chubby bugger who's right at the end, he got him right at front. He said, everyone follow Birdie, some name like that. And because he was the slowest guy, everyone else was kind of in line behind him. Because everyone was faster than him. So that kind of got it together. Now the trick is, how can I get this Bernie guy to become faster? And I think that's what Amazon did. So they got the production line absolutely clear that these are our steps. And then they said, okay, how do I get the first one to go a little faster so that everyone can go faster? So that's what that book actually tells us. Very nice book.
So I want to ask you one more question. I think last time also I'd asked you this. Very basic, okay? the market has fallen. How would you screen today if you had to go on screener or stock scans anywhere? You had to screen something today. How would you screen and find out companies? What would your parameters be? Just tell me in general so that people can also go and find good companies, like your fundamental correction screener.
Yeah, so not much has changed there, at least from what we had discussed last time. So the EPS growth rate or the profit growth rate, revenue growth rate, so that part still remains.
How much would you like it usually?
I would generally keep it at 20%.
So EPS growth rate at 20% over like 3 years, 5 years, 1 year?
7, 8, 10 years.
Okay, long-term horizon is 20% EPS.
So how do you do it on a screener is EPS growth rate 10 years greater than 20 and EPS growth rate 7 years greater than 20 and 5 years 20 and 30. 3 years also more than 20. So that's the growth part is kind of, so I still want consistent growers. I don't want people who are just kind of jumping here and there, number one. The second thing is the P ratio becomes very important. I don't know if I said the PEG ratio last time, but I have now realized that PEG doesn't
capture the true value,
capture the essence of what you want to do. So the problem was, and this problem happened 1.5 years back. So I was okay at that time to have a company which was at a P ratio of 50, saying that, oh, its growth rate is 100.
So, okay.
So 50 divided by 100 ho gaya, 0.5 becomes the PEG ratio. Now I'm like, no way. PEG ratio is a thumb rule. Let it be a thumb rule. Don't try and make it a firm rule. Your firm rule is your P ratio. Okay. Now, P ratio, again, it's a historical P ratio because it's the current price divided by the last 12-month earnings. You ideally don't want that. What you want is projected earnings. Okay. So that's why the next phase also happens wherein I try and see, but you can't do it on a screener. So on a screener, I take what is the current P ratio because I want to capture that fall that comes in. The third thing is, I've also realized another thing that although I love owner operators, the promoter share, if it's too high, then it becomes a problem because you lose out on free float. So, for people who don't understand this, if the promoter holding is 75% and let's say some mutual funds and some FIIs have also bought it, let's say another 15%, for example, your free float is genuinely only 10%. Okay, which means the price of that share is being decided by 10% of the shareholders.
Yeah, very fluctuating.
Yeah, so it's more volatile in that particular case. So what I try and do is I try and keep a promoter holding range of 35 to 65.
Okay, good one.
So that I can at least have about 20% of the public holding on to shares. So there's a proper kind of price discovery that happens. Yeah, so I try and get that also into account. The other thing I also look at now is the OPM of the business. And I match the OPM with the business model. So for example, I spoke of this Gravita and all those recycling companies, right? Now, what are they recycling? It's very important. So when Gen Recycling recycles copper, it is recycling the copper and it's converting into value and it's selling it in the market. If the price of the copper is at its highest, which is the case at the moment, then you have to be very careful of what you assume the future revenue growth will be. Because what if the copper price normalizes? If it normalizes, then the copper per ton, if it's getting, let's say 100 rupees right now, it might get only 80 rupees.
So even if their volume increase, but if the price goes down, you're still at stagnant revenue.
Because your average realization goes down. And there are lots of examples for this. So, for example, Hariom pipes. Okay, I still have it and it's been a mistake. The price of steel is what determines the price of those pipes, basically, right? These are stainless steel pipes. So in this case, the price of steel has crashed by 40% from what it was in 2022 as compared to where it is now. So when our management at Hariom Pipes gave a ambitious estimate in 2022, they were using the price of 2022 to give that estimate.
They didn't know what's going to happen.
Hamara revenue pahunch jayega, whatever was that number. They are not going to reach that revenue for another 2-3 years from the way, unless the price of steel goes up once again. Right?
Yeah.
So again, that's a mistake that you should not do. The volume increases. So I'm just kind of adding a little extra to it. But these are the main things I would love to see. The P ratio, the growth in sales, the promoter holding, and definitely the operating margin. If you can get an operating margin of more than 20%, then very good.
Wow, more than 20% will be very good. Yeah.
It's actually a very good number to have. So these become the basic tenets that I look for.
Anything on debt?
I like an interest coverage ratio of more than 5.
Okay.
So I simply use interest coverage ratio as this thing so that they can service the debt. I look at that. Then comes so you have a list of companies obviously from there. Then comes in the additional things. What are the other things I want to look at? I want to look at companies which can probably double, triple, become 5 times in the next 10 years, for example, right? So we want that long growth runway to be visible to you. You also want companies which are at a phase where they are increasing their capacity so that you can see short-term growth also there. The spike, right? So some of the stuff which I have right now, these are companies which did that 2-3 years back, and now they are enjoying the fruits of it, which means there won't be a spike right now. But they're also preparing for the next growth phase. So they are building in those capacities at the moment, and they are preparing themselves that from FY28 onwards, for example, we will have another phase of 20-25% growth. Right now, it's at about 15%.
So capex coming in with good utilization, and they're peaking, or means they don't have any more.
Yeah, and their core business should be intact. It should not be, the core business should not be suffering because of this capacity increase. So when does that happen? When you take in too much of debt, for example.
Correct.
So your depreciation is also going up, and your debt is also going up, and this is affecting your PAT basically, right? Your operating income is not getting affected. Your margin, the operating margin is not getting affected, but the entries below that gets affected, and your PAT goes down.
Correct.
So you really don't want that kind of a situation also. But you want companies, which are kind of growing, because growth ultimately leads to a lot of rewards as compared to anything else. And that's what I look for.
And you go through them manually, like, because there'll be some 50-60 companies.
Yeah,
so do you
I go
keep
through
like
them manually only.
Do you have any preference? Like, I like companies. So there are two types. Preference as in, like, I like some companies that are very peacefully growing every year. Right, but they don't grow at 30, 40, 50%. They'll grow at 15 to 17%. Beach mein capex spike will come, and that changes the compounding trajectory. That is one type of peaceful guys. Second is thematic, as you said, right? So we know that electrification is a theme, and something comes in that's greener, would your eyes go there? So how do you balance this?
So for me, the thematic is more on the sustainable growth part. So like I spoke of electrification as that thing. I spoke of recycling as that box, or even on a singular basis, airline travel, for example, right? We're not going to go back to trains, right? So we know that, there is only one way up, quite literally and figuratively also, right? That airlines is only going up, right? So that's the overall theme which I definitely see. So this is where I knock off a few things. So this is where the one level of rejection actually comes in. So certain things I'm not interested in. Ye nahi karna mere ko karke. Certain things are where I also, I always tell people that they say, एक select करना मुश्किल है company. So out of 100, for example, that screener might throw up. I said, is it easier for you to reject 99? So your first attempt, once you have those 100 companies, should be to reject.
Yeah.
Like, I don't understand banks and NBFCs.
Core competence types.
So हटा दिया सबसे पहले. First thing that gets removed is in finance, banks, capital market, all that first.
For me,
removed.
textile also comes there.
So yeah, I'll come to that also. Then there are these companies where you've been hurt. Okay, so you have some chemical companies, CDMO will come in, So you don't understand that business because these are certain lumpy businesses, right? Textiles, for example, becomes very lumpy. Sugar is still, there are new applications of sugar which have come in, which was not the case earlier, right? So you have ethanol, which is there. You have distilleries, which are there, so those things have come in. But core, you don't have much. So I knock off those also. So that comes down to maybe 30 odd companies that seem reasonably decent. And then you kind of read up and try and figure out which ones make sense for you. From an investor perspective, I think this is where this entire thing on asset allocation becomes extremely important, right? So don't put everything in one this thing. Like, I talk only about small and micro caps, but then the way I've kind of divided my own portfolio is to say ki my mid caps and my large caps is taken care by mutual funds. It's a decent this thing. It's about 50% in large caps, 25% in mid caps, and all of it is mutual funds. And the remaining 25% is in small caps, which I'm handling on. That's my own. So I get the best of all worlds. So I get my mutual funds doing what they know to do. I don't have that skill of evaluating large caps anyway. I'll throw almost everyone out actually. So that they will do. Mid cap still I can do. Then it's very well balanced. That I know what I'm good at. I can put my efforts there. Someone else is looking at the other part. It's a good 65-35 ratio kind of this thing, distribution between large and mid versus small cap. So it's the way you got to balance this particular thing. But yeah, one thing I've learned is that it's always good to keep some cash.
I think next cycle I'll be ready with that. I think this time I was not ready with that.
Kept that thankfully. I mean, I didn't do anything, Shashank, for a year or so. I mean, my stock portfolio was just there where it is. I was buying, selling. I was recalibrating that portfolio. The crap was going out, this thing coming in and everything. But now is that period where, I felt, okay, the good ones are available now. And now it's the best time for me to kind of add this thing.
That I didn't do well. So I'm adding, but not as much as I'm supposed to add, or which would make a significant impact on portfolio.
Yeah, I want to get to a position where I learn how to sell as well. It's not very. A lot of people say you have to sell, but I'm sitting on certain stocks which have gone by 30x.
Yeah, it's not easy to sell.
So if I had sold it, I'm sure in the last 3-4 years, with stocks like, let's say, Persistent, for example, which I had bought at 200 prior to COVID.
My God.
Actually, a week prior to COVID is when I bought Persistence at 200.
How would you try? Oh, the management change you were tracking at that time?
So even from a pure valuation and a revenue growth perspective, it was very decent at that time, right? So I think that would have been the first trigger, correct. I was not like into the management thing too much. But the point is that, from 200 went up to 6,000 or more maybe, right? So that's a 30x. But if I had done this selling exercise, I'm sure there would be at least 5 to 6 moments where, my trigger would have said, okay, it's time to sell.
Yeah.
So I'm not able to get my head on. So I think specific stock selling might be a bit more difficult for me. But now I realize that, there are times when the overvaluation thing happens. And you should kind of knock off during that time, prune that thing, go more towards the large caps. So all that stuff is there. You can actually see these small things. So for example, the Nifty Next 50 index, it's an index. So it's got 50 stocks inside it, right? Some people can argue saying, oh, this stock has come in with a large P or a low P or this thing. But yeah, 50 stock hai yaar. It's not like, it's not a very skewed kind of a thing like the Nifty 50. There, I think the highest is maybe 4% is the maximum weightage for a particular stock. So that thing is currently at a discount to the Nifty 50, which almost has never happened.
Wow. So people are pricing in large caps more than the mids. Yeah.
But there's also a large cap only.
But the next 50.
The next 50, yeah, correct. So it's also a large cap, but they're pricing it at a lower multiple as compared to the first 50. Yeah. So the first 50 is what? Must be at around 20 if I'm not wrong. Currently. This one is at 17 something.
That's very attractive.
It's generally been at least 2 points above. So if it's 20, it's 22 normally. It's currently at 1780.
That also means that these guys, the next 50 is actually growing earnings better than the top 50 as well.
Might be. So that's there. I think the biggest company within the next 50 is LIC in terms of total market cap. Definitely not in terms of free float market cap. But in terms of total market cap, it's LIC there.
Very interesting. Awesome, Shankar. I think, first of all, thanks a lot, because
No,
I think every time we sit like this, it's fun to just sit, relax, talk.
It's like stop gupshup.
Yeah, it's like a gupshup. Like it's good to talk to people who have the same ideology and the same mindset, right? Usually we would do this over a coffee. I said, camera laga do aur baat karte. But again, thanks a lot, Shankar. I think what you've been doing on your YouTube also is amazing. Even I keep watching almost all the videos. It's so beautifully described, and you go so deep into it over 20-25 minutes, which is just wonderful, right? And so many good companies in good niches I have also found from via you, because if I had to do it, it would be very difficult for me to do research as well. So again, thanks a lot for what you keep doing on YouTube, and I hope all of you guys like this as well. But I'll keep irritating you more whenever I come.
Anytime.
Next time कुछ अलग cycle होगा, hopefully we're in a good cycle. फिर वो time पे भी एक बार बात करेंगे.
उस टाइम पे आप मेरे को पहले prepare करके आने बोलना, so that people watching it also
Done.
can really get some more insights.
So next time in a bull market, I will come and sit with you, and we will have a very nice session again.
Bull market में कंपनी ढूंढना थोड़ा मुश्किल हो जाएगा.
तो हम ये reference लेंगे. See, that time we spoke about it. Awesome. Thanks a lot, sir. Thanks a lot for coming.
Thank you.